But of course, let's get more analysis. We believe the blocking of SWIFTs could have negative impacts, particularly for chains leading into natural gas, and further unease for investors to start the week after Russian President Vladimir Putin ordered his military to put nuclear deterrence forces on high alert overnight, with reports Ukrainian and Russian delegations are expected to meet with preconditions on the Ukrainian-Belarusian border.
Well, for a reader on the week ahead, good luck. Pete McGuire from XM joins us here on the program. Pete, so much news to digest out there at the moment. What's the thing that you're watching most acutely at this point in time?
Well, good morning, David. Good morning, Cara. I've got to keep a close eye naturally as far as the impact of the SWIFT system and how that reverberates through naturally Europe, and Belgium as the headquarters as far as SWIFT, and what happens as far as Russia. Then you're looking at the contagion effect as far as natural gas supplies into Europe and natural gas supplies into Asia, which, just for the readers or for the viewers' standpoint, 48% natural gas into Europe, 36 into Asia, and 12 million barrels a day to the 100 million barrel consumption. So we've got OPEC talks. It's going to be very awkward there, and non-OPEC meeting this week, not non-OPEC members, and the framework around that, who's who in the zoo. So it's going to be a very delicate time, and I think that energy prices could go, parabolic from here.
So energy price is high, but a risk-off sentiment. So what does that mean for commodity currencies like the Australian dollar?
Oh, I think it'd be volatile, Cara. It's a hard one to, these are unusual times. You've got talks as far as nuclear. You've got talks as far as, shutting down whole economies. 10 major banks in Russia, what the impact's going to be there. The whole story is just, I think, going to be very, very volatile. What happens as far as when you're looking at gas, you're looking at you're looking at oil, no one can fill that breach. So I think that commodity trading currencies are going to be, whipsawing and quite volatile and quite, turbulent, to put it mildly.
European currencies. No, the rouble, we were just talking about it before we came to you. Grey markets now being quoted at 200 and 200 plus to the US dollar. Surely there's going to be spillover effects to the euro and other currencies out there.
Absolutely, David. We're sitting at around about that 111 for the euro, so I'm expecting US dollar to probably strengthen further from here. Softness has crossed the Eurozone and, of course, to the euro, yen. I think it'll be for a trading perspective, sometimes it's good to be out of a market just to actually take on board what's actually going on, because of the large whipsaws that once banks get operating in this arena, it can really be quite frightening for smaller retail investors. So there's a time and place to sit on a banana chair. You should have had a great week last week, and this week could be just one to sit on the sidelines for the first 24 to 36 hours and appreciate all of these parts coming together.
Are you buying gold at the moment, Pete?
I think it's had a big sell-off. You're down at 1887. We've lost $80 in the last couple of trading sessions. So it's been, again, incredibly volatile, Cara. Over the last, say, 2 months, you've seen from 1780 up to 1960, and then back now we're sitting at around about 1890. So again, hugely volatile, silver the same. And that really creates, if you're prepared to be a trader, you can do extremely well. Looking at your fundamentals, taking on board your technicals. But the reality is, I think that the world is buying more gold physically, Cara. Certainly India, across the Asia region for times of risk, and Middle East. So the addiction's there, and I think a lot of traders and a lot of investors are looking at it as fairly cheap at the moment.
Pete, talk to me about central bank meetings this week. There's a lot of data out as well, being the start of a new month. Is that just all secondary considerations, or can you go and find some opportunities from those particular events?
Well, I think you've got to look at opportunities. Have a look first off, where the US closed, and you were mentioning as far as the SPY futures before we opened, we're up 2.4% or so. Dow was strong on Friday, up 2.5%, NASDAQ 1.6%, and about 2.25% for the S&P. And England, the FT was up, I think, 3.7%, 3.8%. So it's strongly bid up. I think that momentum, it'll be interesting how it runs tonight. So when you're looking at, the central bank meetings, you're taking on board GDP numbers, PMIs this week, and so on, and we've got non-farm payrolls on Friday, then I think volatility. You know, we had a big move to the upside Thursday and Friday. Maybe there's going to be a little bit of exhaustion and we could see some of those gains given up, considering what we experienced in taking on board the SWIFT action of what that impacts to Russia and to the globe.
Pete, what are we seeing when it comes to crypto?
Oh, Cara, I just think more volatility, and that volatility is one thing that traders are going to be either embracing or if you're prepared to embrace and prepared to take on board that it's a 24-hour-a-day market, then many traders, the retail sector just absolutely loves it because of those big swings and roundabouts. So I don't think that that's a bad thing to, if you're a momentum trader or you're defining what your risk metrics are and how you action markets like this, the crypto is not going to be disappointing this week.
But just to go finish off, you've seen a lot of volatility events over your time. Position sizing that you're using at the moment, are you starting to go and reduce down the size given how whippy it is?
David, it just depends. I mean, if you're looking, first off, we've got to take on board what ASIC did to our industry last March. They changed the footprint and brought in line very similar to what they did in Europe and UK. So the leverage was dramatically reduced, and that changes the footprint as far as retail traders. So there is only so much leverage you can get. Now, this comes down to, again, risk metrics, comes down to appetite from traders and what they're wanting to achieve from a particular trade. So as you dial down leverage, you have I think you're minimizing your risk as well, or certainly taking some of that risk off the table. So that's a plus in a lot of ways. And I think it looks after traders' best interests.